Welcome to Sifter Fund's Year in Focus. Sifter has one equity fund, and we have decided to invest in high-quality companies globally. Over 22-year track record, we've been able to outperform the stock market, not every year, but most of the years. We want to invest in high-quality companies in a long term. A high-quality company has a predictable earnings growth, it's not too expensive, and it's predictable business. In 2024, Sifter Fund return was 10.8% in euros. It's not one of our best years, but it's better than the average in 22-year history. So let's go deeper into the Sifter Fund's main events in 2024 and what thoughts this bring to you, Alexander, the last year's return.
Well, it was a positive return, which is a great thing, of course. And the first half of the year was really splendid. But in the second half of the year, we got several headwinds stemming from issues in the semiconductor industry and related to one of our biggest investments, Novo Nordisk. So as a whole, we did return less than equity indices in general. But then again, we don't really care about one-year performance. We are long-term buy and hold investors. So for us, the long-term is all that matters. And if you look at the fund's performance over long term, we have indeed been able to provide excess return with our focus on this one investment process and philosophy.
And one principle that we don't want to take extra risk to get returns. That's something what we've been following also last year.
Yeah, we have not changed our investments process in any way. It has remained stable as always over the years.
Yeah. Let's look at the last year's top and bottom performers. The biggest gainers in last year were TSMC, Costco, and Alphabet. And then we have some, let's say, not so good performers, Novo Nordisk, Canadian National Railway, and SMC.
Yes.
So TSMC, for example, it's like an exception in the semiconductor businesses since most of the semiconductor companies didn't perform that well. But why TSMC did that well, so well last year?
Yeah, indeed. TSMC has indeed been a strong performer in its own markets. If you look at the closest competitors like Samsung and Intel, TSMC has by far outperformed them in this period. This has been the winner that has been continued to winning in this market. Intel tried to challenge TSMC's leadership position, but in August they decided to no longer go forth with the current planned capex plans. And Samsung, on the other hand, has been hit by the continuous weakness within the memory industry.
Well, how about Costco? It's totally different business model, so...
Well, yes, Costco doesn't have anything to do with semiconductors, which is a good thing. Costco has indeed been outperforming for 2 years in a row. And the main driving factor here has been the rate of new members increase in the Costco model. So Costco makes most of their revenue from membership revenues. And the number of new members that enter into the Costco ecosystem has been growing at a rate that's higher than the last long-term historical average. Why? Well, it could be that the recent years of high inflation has reduced the purchasing power of the US middle class. And that has forced them to shift their spending behavior to more reasonably priced shopping outlets. And this is exactly what the Costco model is. They have the cheapest goods in their own industry. Of course, they get most of the revenue by the membership fees.
Yeah. And then the third biggest gainer was Alphabet. And you remember 2 years ago when ChatGPT was launched, so many thought that the time for Alphabet is over now because there will be competition. But what made Alphabet stock price to rise that much last year?
Well, I guess you could argue the argument that you said that ChatGPT is going to take the lion's share of Google's business has not been realized. That's one reason for good performance. And in fact, the fact that Alphabet is a very large player within the cloud space that offer infrastructure that its customers can use to train and develop their own AI models. And that has been a tailwind for the company in this year. Another interesting point is that if you look at the peer group of Alphabet, it has been, at least in this year, drastically cheaper than the other companies like Microsoft or Amazon.
Yeah.
One reason for the good performance could be that it's catching up to its peers.
Yeah, that's one thing, and also the predictability. So it's much more easier to predict the earnings and the revenue growth for Alphabet than, for example, for Tesla, which is a totally different kind of business model, of course. If we look at the losers, so to say, so we have Novo Nordisk, so we will speak about the Novo later and dig deeper on that. But how about the Canadian National Railway and SMC? Is there like a common theme for those companies?
There is, even though a railway company has little to do with a Japanese pneumatic valve manufacturer, but the common concept or the common core these companies have is the fact that they are both serving the heavy industry, so traditional manufacturing, and that has been a kind of a laggard in this year. So even though global GDP has been growing quite well, as we know, it has mainly been driven by the tech sector and the service sector. But traditional manufacturing has been doing quite poorly, and that's also reflected in these two companies.
All right. Well, let's look at the main changes we conducted in the portfolio in 2024. We were quite active in that year. Let's highlight the biggest changes.
On the selling side, we got rid of 3 investments in there entirely. Now, it's good to put a background on why we did this, because we have these 3 core pillars that we are looking for in our companies that we invest into. They should be in a growing market, they should have strong competitive advantages, and a reasonable valuation. In the case of Cisco Systems and VeriSign, which we sold completely, the first factor was lacking. Cisco System is a big dinosaur of a company that just cannot in any realistic way grow faster than global GDP growth in the long term. And that's the reason why we disposed of that company. A similar characteristics found with VeriSign. They sell the .com domain name, but the entire base of .com names in the world is no longer growing. It's in fact turning around and starting to shrink. And that's also a reason why it's no longer in compliance with our goal of having companies with growth opportunities. The last company we sold was Sony Corporation. The investment hypothesis of that company did not turn out with our expectations. We wanted Sony to sell consoles, the PlayStation 5 consoles, in large enough numbers that they can get this kind of free revenue by licensing these gaming companies to make games for the PS5 platform. But since the company had a lot of issues getting PlayStation 5s to market and had found that the demand has not been good enough, this investment hypothesis has turned out to be, well, not in line with our expectations.
So we received money from those divestments. So in which companies we then reallocated that cash?
We have 2 new exciting investments in the portfolio. One is the Norwegian company, Tomra Systems. They make these bottle deposit return machines. That's especially being important now, given the fact that the European Union is demanding that these kind of systems be implemented in all of the European Union member countries. There's a very good long-term growth trajectory there. The other company that we introduced into our portfolio for the first time is the Swiss-American company Mettler Toledo, which is a leading in kind of load cells and weighing equipments for industries and biotech industries.
All right. How about the other companies we increased the position in the last year? Anything what is common for them?
Well, we increased the weighting of Alphabet, which is not related to any other, but we also did increase the weighting of Applied Materials and Lam Research towards the end of the year, because they had a big drop-off in the summer, but now at the current price levels and given the future expected recovery of the semiconductor cycle, we think they are attractive opportunities at this moment.
All right. Well, let's look at the biggest investment in the Sifter Fund. Investors are often asking from us that in which companies we are mostly exposed, and we have Microsoft, we have Novo Nordisk, we have Safran and TSMC. Well, the Microsoft has been a remarkably steady performer over 10 years. We've been invested in Microsoft over 10 years now. So there's no high or low lights in Microsoft, or what do you think?
Business as usual.
Business as usual. We will stay invested in that. But then Novo Nordisk.
Not business as usual, no.
So we invested 4 years ago. What do you think? Is it still worth being invested in Novo, or what is your outlook for Novo?
Well, the main point to highlight with Novo from the last year is the fact that there has been perhaps a change in the competitive dynamics for the company. So the background for this is that they had a new drug in the phase 3 pipeline called CagriSema, which basically the management had promised a 25% weight loss over the duration of 1 year. And that would make this the leading weight loss drug currently for sale on the market. The actual results came in at 22.7. So not a drastic miss, but still, compared to the competitor, Eli Lilly, they have another drug called Zepbound, which also produces a weight loss of roughly 22%. So in that sense, this was a disappointment to the market that this new drug was not better than the competitor's currently available for sale drug of Zepbound. So indeed, this does a little bit cut away at Novo Nordisk's leadership against Eli Lilly. And in fact, one can argue that Eli Lilly now has the slightly better product portfolio. But then in the bigger terms, this is still a market that has severe, although improving, shortage of weight loss drugs. This market is expected to grow at very high teens over the next 10 years to become a $100 revenue market by 2030.
100 billion.
Billion.
Yeah.
And there is still, these two companies are still both by far the best and leading companies at producing diabetes and weight loss drugs.
Well, how do you see the Novo Nordisk valuation with current share prices? The share price came down roughly 10% last year. So based on your outlook for the next 5 years and the current share price, so what is your take on that?
Currently, it is offering a yield on investments that's slightly better than our portfolio average. And especially if you look at the peer group, like Eli Lilly here is the obvious example, it's twice as cheap as its American competitor. So in that sense of view, the fact that it got slightly lower market leadership positioning against its competitor is more than compensated for by the cheaper stock price.
So one more question regarding Novo Nordisk, the financial figures. So we invested in 2020 and the revenue was a bit less than 20 billion on that time. And now it's expected to be almost 40 billion in 2024. So what is your outlook for the next 3 to 5 years? Does it still continue growing, and what could be the revenue and earnings expectations?
Well, the revenue should be growing at high teens for the future. So, of course, the weight loss market is going to go towards $100 billion in the next 5 years. And we expect Novo Nordisk to keep up with Eli Lilly in that race to the 100 billion. And regarding the pricing, there will be a major price renegotiation in the US in 2026, which could have some impacts on reducing revenue growth and perhaps some minor impact on the margins. But then again, currently, the gross margins for Novo Nordisk has been north of 80% and growing. So indeed,
over 80% gross margin.
Yes.
That's too much, one could say.
It could be too much, and it's probably going to go down in the long term.
Well, the operating margin is around 40-45.
Yes, even though the company is now reinvesting more profits than before in R&D, the operating margin has still been sustainably very high. And that gives us some confidence in the future that these new and novel investments could lead to the next generation of miracle drug that the current weight loss drugs have been.
So it's truly a quality business in many ways when you look at the financial figures and the expected revenue growth and the earnings growth.
Yes, the only main uncertainty with Novo Nordisk is the long-term competitive situation. And of course, you have the additional aspect of cross-country border regulations and in different jurisdictions, for example, that could negatively impact this company. As you said, 80% gross margin is too much to bear, perhaps, for some countries.
All right. So as a conclusion, we remain invested in Novo.
For the time being, we are still, very much invested in Novo Nordisk, although we are still anticipating more data related to this new drug to come in next year, which might change our opinion.
And with regard to our high conviction cases, Microsoft and Novo, So we remain roughly 6-7% weight in the portfolio each. Is that correct?
That's roughly the ballpark, yes.
Yes. So we have maximum 10% for one company, and once we have been close to 10% with Microsoft and Novo, but currently roughly 7%. How about Safran? Safran is a French aircraft engine manufacturing company. It's our third biggest investment. So what makes Safran business so steady, and why do we like it?
Well, Safran has two main revenue components. They sell engines, obvious revenue source, and they sell service for these engines. The engines themselves, they basically sell at a break-even price, making no money on them. But it's a very predictable business because if you look at the backlog of Airbus and Boeing, two major customers, they have a backlog of 8 years both for new airframes.
Okay.
So we know exactly how many engines Safran is going to be selling over the next 8 years, as much as they can produce, essentially. And the other component is the service business, service income. And in the last 10 years, Safran has been selling quite a lot of these new LEAP engines, which is the most modern engine that they provide. These are now soon to come in for their first major overhaul, which typically happens every 7 years. So we can also, with high degree of certainty, forecast the service cash flows in the future. And over the longer term, this industry should be growing by the rate of aviation in general. And since the pandemic, we have now returned to similar volumes as we saw before, and currently the load factors as well, indicating how much planes are flying and how much tickets are being sold, are also at normalized levels. So indeed.
So expected earnings growth, quite predictable in the long term, and high barriers to entry.
Yes, we will see a competitor coming far away because it takes 20 years to develop a competing engine.
Our fourth biggest investment is Taiwan Semiconductor, and the main reason is that its share price almost doubled last year. Even though we decided to reduce TSMC's position in the end of the last year, why we are still invested in TSMC, and what was the reason for this reduction?
Well, TSMC, even at the current lower weight in the portfolio, is still an amazing investment. So they are the world's producers of high-end semiconductors, and for example, NVIDIA has been buying all of their chips from TSMC. And that's not going to go away because, as I said earlier, Intel has problems with challenging this market leadership position. However, in the last year, the stock price essentially doubled, which means that the future earnings yield correspondingly goes down as well. So that's one reason for reducing the weight. The other major reason is risk management. So I would argue that in the year of 2025 and beyond, it has become even harder to forecast the stability of the geopolitical situation in the world with more certainty. So there could be the probability of some negative event, especially around the DC of China, which could negatively impact TSMC, is now slightly higher.
So risk mitigation was maybe the
other cause.
Yeah, exactly. So it's interesting that the largest investment in the portfolio is Microsoft from the IT sector. Then we have Novo Nordisk from the pharmaceuticals, Safran industrial player, and TSMC, which used to be one of the largest, but now it's less than 5%. So it's not the high conviction anymore in that sense.
No, we added Alphabet to the fourth high conviction investment right now, so that's the fourth biggest one.
Yeah, so it's a communication services. So it's a really nicely diversified portfolio when it comes to the largest holdings. Thank you very much, Alexander.
Thanks.
So now we have covered the Sifter Fund's main transactions last year and the top and the bottom performers. It's time to move on the Sifter Fund's global allocation, geographical and sector allocations. End of the last year, Sifter Fund was exposed in the North America 56%, Western Europe 32%, and Asia Pacific 11%. When it comes to sector allocations, we were the mostly exposed in information technology, a bit more than 30%, industrials a bit less than 30%, and healthcare 16%. So Carl, what does this allocation and allocation changes during the year tell to you?
Well, as you can see, our North American exposure has increased a little bit for the first time in a long time. And again, the result of our changes in both geographical and sector allocations are obviously not due to a kind of high-level strategy, but all a consequence of our bottom-up analysis and investment decisions, as every Sifter investor knows by now. But yes, the North American weight increase is due to us choosing to increase our weight in Google, also the share price increase in Google, and also share price increase in ADP and a little bit increase in Old Dominion. And conversely, this has led to a decrease in the weight in Asia Pacific due to exiting Sony entirely. And also at the end of the year, we did reduce our weight in TSMC a little bit. Do you want to know about our sector allocation changes?
Yes, please, and especially the industrials, which are the biggest change has happened in industrial sector. So, what is the main reason for that?
Well, the main reason for that is Tomra, one of our two new investments last year, and IT is another noteworthy change. As you can see here, it reduced by almost 7%. And historically, Sifter investors know that we have had a quite large overweight in IT compared to the index, for example. And this decrease now, it stems from two reasons. One is, as Alexander mentioned, we divested Cisco and Verizon entirely. And the second is that we reduced our weight in some semiconductor companies, and their share price performance has also been a little bit less on average than our Sifter portfolio. Now, you can also see here that healthcare has increased, and that's a little bit funny because that's actually due to our investment in Mettler Toledo, which Alexander talked about. And yes, it does have healthcare customers, but I would perhaps put it more into the industrials. Exactly. And conversely, also with communication services, that's Google, and I think you and I would agree that that's perhaps also more of an
IT company.
Yeah.
But we are quite exposed in the three sectors: technology, industrials, and healthcare. So what is the main reason for that there's a little bit like a focus on those three sectors?
Well, there's good reason for that. And these are sectors where you can really find predictable growth. And you can also find companies with strong competitive positions. They have competitive advantages and barriers to entry.
And high margins.
High margins as well, and usually also quite good financials. And if you look at industrials and IT companies, also valuation comes to mind. And that's one the reason why we have such a large exposure to industrials. Because here you can find all those great things we like in a quality company, but also reasonable valuations. And yes, we do have companies in IT space also with reasonable valuations. But conversely, in IT, as you are very aware, there are companies which have, well, unreasonable valuations.
Yeah, let's talk about that later when we talk about the prices and valuations.
Yeah.
But investors often ask from us that how the allocation has changed over the years. And there's one noteworthy aspect of Sifter allocation, especially geographical allocation has changed. So, for example, North America allocation has decreased by 10% over the last 6 years. And this is, I think it's quite interesting because the stock market in US has been performing extremely well in the last 6 years. And we've been like underexposed in that area.
Yeah.
So how is it possible that we've been able to outperform the market even without being that much involved in that market?
I think it just goes to show that we believe that we're on the right path with the bottom-up analysis approach, that you can find good investments in globally, not just in North America. And indeed, in these last years, it has been, in fact, increasingly difficult to find reasonable valuations in North America.
Well, this leads us to the next topic, namely expensive companies are getting more expensive each and every year. And in recent years, we have observed that especially the US tech companies are getting more and more expensive. And sometimes for a good reason, but what kind of role pricing and valuation plays to us in Sifter portfolio management?
It naturally has a very central role in when we evaluate the risk-reward relationships of our potential and current investments. And it is our continuous task to monitor these changes both on the short and the long term to figure out, are these changes justified? And although we are long-term investors, we need to have the capability to do these short-term changes in case there are fast changes in share prices. And we have done that. And two examples of that is, for example, in 2024, when Disco's share price increased about 200% in 1 year, we looked at the future growth estimates and they didn't seem reasonable. So we had to reduce the weight. And that is probably been a good idea. And conversely, in 2022, when semiconductor equipment manufacturers were, in our view, attractively valued, we increased the weight. And, well, we have a longer track record from that, and that has indeed been a good decision. So in this way, yes, while we really emphasize the quality of the companies, share price does have a big impact.
Yeah. So that's kind of like the role of the active management to take decisions when we see opportunities.
Yes.
So let's make it a bit more concrete and provide this argument with the data. Compare the S&P 500 index valuations to Sifter Fund valuation. So what kind of observations we can receive from there?
Looking into the valuation metric that we have chosen here, EV/EBITDA. Historically, as you can see, S&P 500 has been about 20 to 30% more expensive than Sifter. Then in 22, 23, we reached parity. But now again, at the end of 24, we're back to normal level where S&P 500 is more expensive than Sifter.
Okay, so that's on the apple-to-apple level, so S&P 500 and Sifter Fund on average. Then if we go deeper to the tech companies, and we know it that tech companies are leading the index returns, especially last year. So if you compare the valuations of the tech companies, and especially the tech sector in S&P 500, and there's roughly 70 companies in that sector. So what is the conclusion?
Well, if we look at first on Sifter tech companies, yes, they are a little bit more expensive than our average portfolio. But then if we look at the S&P 500, the difference is quite huge. So when you take it all together and remember that, as you said, in the index, the tech company weight have increased year after year and the valuations are this high, it's not an understatement to say that these are really what's driving the US equity market.
Well, that's a huge difference.
That's a big difference, yeah.
Then we can also look at the Sifter Fund historical valuation, and we are applying the earnings yield method. And when we look at this graph, we can see that the historical average for the Sifter Fund's earnings yield has remained quite stable over these years. And it's quite interesting because the stock market and also the Sifter returns have been increasing almost each and every year. But at the same time, the earnings yield, so the expected earnings yield for the Sifter Fund has remained on a nice and steady level. And what is the main reason for that?
Well, it is our active management. So at some instances, the share prices get out of control and we have to reduce the weight. But also when we want to have a new investment because either we have to exit something because it's too expensive or because there's some problem with the business, we need to find something new. We don't go running after the most highly valued growth companies.
So based on data now, we can see that the S&P 500 is more expensive than our fund. When it comes to technological companies in S&P 500, they are extremely more expensive than our tech companies. And finally, when we compare the KPIs, we can see that the Sifter Fund's business performance indicators, they are at the same level than the ones in the S&P 500. So, of course, we are a bit biased, but we could see that the Sifter Fund can provide more value with discount compared to S&P 500 companies, which are more expensive.
That is what the KPIs would suggest. Yes, that's one good takeaway.
Also, the story can continue that the S&P 500 companies continue to be more expensive in the later years.
Of course.
Let's finalize the discussion and reflect where we have been successful and where we could improve our operations. And if we categorize this reflection point, the investment decisions and then the investment process. So which investment decisions we have been successful in the last year so far?
Well, one of our successes is our investment in the Tomra last year. And I want to highlight here again that it's only been 1 year. And to be honest, 1 year is not a long time. And so the long term will ultimately say were our decisions right or wrong. But so far, so good with Tomra. Another good investment decision was also the reduction in weight of Disco when we didn't see any justification in its high valuation. So far, so good on that front as well. But again, we'll have to wait longer to see.
And also increasing the Alphabet share weight in the portfolio.
That's a good point.
Was an additional positive. Any negative decisions, investment decisions we could have done differently or better?
Well, we did reduce Disco's weight, but there were also some semiconductor companies which were quite highly priced as well. Not as extreme, and we've decided to not do anything about that. So we could have reduced our weight in those, or conversely taken a stronger stance in reducing Disco more. But I don't want to sound like a broken record, but we'll have to wait over long term to see how this plays out.
Yeah, well, you're right. Very often it takes years to see the decision outcome. How about the investment process? Have we followed our investment strategy and process, and is there something that we could improve in this year?
The positive thing is that in these glowing red hot markets, there's a huge kind of urge to give in to greed. And I think we have done well. We can pat ourselves on the back that we have delivered on the promise to our investors not to give in to greed and continue with our investment strategy. That might seem like a no-brainer, but it's not always that easy. So that's a positive thing from the process perspective.
Well, I would say that it's the most difficult part of investing it's a psychology.
Yeah.
And if you have one strategy, it has a long track record, successful track record, you need to stick with the strategy.
That's right.
Thank you, Carl, and thank you for being with us today. Kindly reminder, we have covered Sifter investments and the actions we have taken for the fund during the last year. None of these are investment advice. I wish you a very good investment year 2025.